Welcome to this explainer. Okay, go ahead and grab your financial detective hats because today we are zeroing in on a really fascinating situation with the semiconductor equipment manufacturer SUSS MicroTec. We're looking at a market setup right now that is pulling in two completely opposite directions, and we really need to get under the hood and figure out exactly what is going on here.
So let's just dive straight into the big mystery. When you look at their recent reporting, you immediately hit this wall and have to ask, why on earth would a company that is experiencing an absolute flood of massive orders suddenly guide for lower short-term sales and practically slash its dividend payout to a measly 30 cents a share? I mean, aggressively cutting your dividend while sitting on a mountain of record cash orders? That's the kind of paradox that gives investors whiplash. It feels totally counterintuitive, right?
To actually solve this puzzle, we're going to logically break the evidence down step by step. First, we'll look at the SUSS MicroTec paradox itself. Then the Q1 2026 record orders. Third, why 2026 is their transition year. Fourth, their massive Strategy 2030 growth targets. And finally, we'll tie it all together with valuation and a target price.
Let's kick things off with Section 1, the SUSS MicroTec paradox, and navigating these wild mixed signals. Investors right now are stuck in a massive tug-of-war. Simply Wall Street's recent analysis really highlights this tension perfectly. On the bearish side, you've got these blinking caution lights, the dividend cut down to 30 cents, softer Q1 sales, and kind of muted photomask orders coming out of China. But then, on the bullish side, you have incredible, undeniable long-term tailwinds. We are talking record order intakes, dominant market share, and this absolute tsunami of demand for AI advanced packaging.
To ground us in reality, let's actually think about the hardware driving these numbers. SUSS MicroTec builds highly specialized process equipment for the semiconductor industry. Think of the super intricate machines used for advanced back-end packaging and cleaning photomasks. Basically, these guys are selling the high-tech picks and shovels required to build the next generation of AI microchips.
Moving right along to Section 2, Q1 2026 record orders and how they form a foundation for stability.
Okay, this is the number you need to pay attention to. 86.5 million euros. That represents their record high order book intake as of March 31st, 2026. And look, this isn't just a minor beat. This is a massive, foundational backlog that practically screams that the baseline demand for their technology is incredibly healthy.
Now, obviously, we have to square that giant order book with the reality that actual realized sales in Q1 were on the lower side. But management has been super upfront about this, stating explicitly that Q1 2026 is expected to be the absolute low point for the entire year. So that massive backlog of orders gives them immense visibility and basically guarantees operational stabilization as the year rolls on.
Which brings us nicely to Section 3, 2026, the transition year. What's really fascinating here is why management is practically yelling from the rooftops that this is a transition period.
So, here's how the timeline shakes out. In 2026, orders for AI bonders are taking a temporary breather, but SUSS isn't just sitting on their hands. They are busy launching 5 entirely new platforms, including their green track wafer cleaning tools. This strategic pause is literally setting the stage for a massive reacceleration in 2027, when their next-generation UV scanners hit the market. It's all stepping stones toward their ultimate 2030 vision.
And to handle this transition without just setting cash on fire, SUSS dramatically cranked up their operational flexibility through outsourcing. Get this, in 2024, outsourcing represented the equivalent of 38 extra full-time employees and handled an impressive 27% of their entire global production. They aren't just building machines, they're turning themselves into a highly scalable, asset-light machine.
Plus, they took 8 scattered, completely separate facilities in Taiwan and consolidated the whole shebang into one highly streamlined hub in Zhubei. This is way more than just trimming real estate costs. It actively boosts throughput, supercharges cost efficiency, and cuts down lead times. They are actively scaling their capacity for the exact moment the next growth phase hits.
All right, Section 4. Let's zoom out to the promised land. Strategy 2030 growth targets. When you look at their 2030 targets, the sheer scale of their ambition is just wow. By 2030, they want to essentially double their revenue, taking it from the 400 million range all the way up to 900 million euros. But here's the real kicker. They expect to push gross margins up to a very juicy 45%, and they're aiming to almost double their EBIT margins to over 20%. That is some serious profitability.
And listen, these numbers aren't just pie-in-the-sky wishful thinking. They're backed by systemic, heavy-hitting market tailwinds. Their total addressable market is expanding at a 7% compound annual growth rate. You've got surging demand for AI advanced packaging, much stricter cleanliness standards and back-end processes, and a smart, deliberate push to make ultra-high margin services account for a full 25% of their total group sales. Oh, and did I mention, SUSS is entering the cycle from an absolute position of dominance. They hold a virtual monopoly, roughly 100% market share in full-field UV scanning, and a commanding 65% share in temporary bonding. That means as the whole AI packaging pie gets bigger, SUSS is fundamentally locked in to take the biggest slice.
Finally, Section 5, Valuation and Target Price. This is where we bring it all home.
The analysts over at MWB Research have dug deep into this exact Capital Markets Day data, the transition plan, and those massive 2030 targets. And their verdict? They have confidently reiterated a strong buy rating for the stock.
Actually, scratch that, they didn't just reiterate a buy. They aggressively raised their target price up to 56 euros flat. Just to put that into perspective, that represents a whopping 31.1% upside potential from the stock's recent trading levels of around 36.62.
And if we peel back the layers on their discounted cash flow model, which is just a fancy way of calculating the present value of all that future cash, you see why they're so bullish. They're using very reasonable assumptions here. A 9.9% weighted average cost of capital, a standard 2% terminal growth rate, and a 6.5% revenue growth rate during the planning phase. So they aren't modeling a miracle here. They are literally just pricing in the math of the company's own stated trajectory.
Seriously, when you plug all of those fundamental, reasonable metrics into the formula, the fair value output lands at exactly 56 euros and 23 cents per share. The math simply tells us this company should have a much, much higher valuation than the broader market is currently giving it.
I think CEO Burkhard Frick really hits the nail on the head when summarizing their posture right now. He emphasizes that operational discipline and focus are the engines driving them toward those highly valued 2030 targets. So, when you look at it that way, a short-term dividend cut and a transitional 2026 aren't red flags at all. They're just the calculated streamlining of a portfolio getting ready for massive scale.
So, I want to leave you with one final thought to chew on as we wrap up this explainer. Does the short-term pain of a dividend cut and a transition year simply mask a spectacular long-term opportunity? If the underlying data holds true, this current pause might just be the eye of the hurricane before the absolute tidal wave of AI semiconductor manufacturing hits. Really makes you think, doesn't it? Thanks for putting on your detective hats with me today, and I will see you next time.